Tom runs a one-man business which revolves around him building wooden swords that he sells at $10 each. Last year, he sold 10,000 swords, generating a grand total of $100,000. We call this amount his revenue. Unfortunately for him, he doesn't just keep the entire amount. First of all, there are direct costs involved in making the swords. These are called COGS, as in cost of goods sold. In his case, we'll say they amount to $4 per sword that he spends on materials. If he had employees, there would be direct labor costs as well. After subtracting the $40,000 cost of goods sold from the $100,000 revenue, we are left with a so-called $60,000 gross income, also referred to as gross profit or gross earnings. Once again, however, he doesn't keep this amount either because there are more than just direct costs involved. Tom's business also has expenses such as rent and taxes need to be paid. Let's say his expenses including rent amount to $25,000 yearly, whereas taxes amount to $20,000 per year. After subtracting the $25,000 expenses and $20,000 for taxes, we are only left with $15,000, called the net income, net profit, or net earnings. Since this amount is usually found on the last line of the income statement of a company, it's also referred to as the bottom line. Broadly speaking, that's pretty much it. The risk-to-reward ratio tells you how much you stand to profit for every unit of currency you risk. A risk-to-reward ratio of 1 to X tells us that for every dollar you risk, you stand to generate a profit of X dollars. For example, let's say you buy one share of company A at $100 and promise yourself you'll never sell until the price reaches exactly $400, even if it means writing the stock down to zero and losing your money. In this case, 1, you are risking $100, and 2, if the share price does reach $400 and you sell, you are left with $300 after subtracting the $100 you've paid for it. In other words, you are risking $100 for a potential profit of $300, or a risk-to-reward ratio of 1 to 3. As another example, Bill's friend Rachel makes him an offer that they both put down $1,000, flip a coin, and whoever wins receives the resulting $2,000. Bill quickly realizes that he would risk $1,000 for a $1,000 potential profit and refuses, explaining that a risk-to-reward ratio of 1 to 1 for a 50% probability coin toss is not attractive since he is not at the probabilistic advantage. A month later, Bill's other friend, Tom, feels lucky and says he would be willing to risk $5,000 on the coin toss, with Bill only risking $1,000. In this case, even if he knows there are never guarantees, Bill accepts because he likes the idea of risking $1,000 for a potential profit of $5,000 on a 50% probability event. Pretty logical, right?